So my question is, are you like okay with the concept of current ratio, quick ratio, cash ratio?
Yeah,
Hello.
yes, sir.
So you're okay with all these three ratios, right? So any kind of like detail regarding these three ratios, like you're familiar with them. Am I right?
Yeah,
So can we move forward for doing questions regarding these ratios?
yes,
Hello?
yes, sure, sir.
Yeah. So while like doing the questions, I'll be asking the formulas as well. So you should be answering, right? Okay.
Okay,
So this is the first question what we have, the acid test ratio. So let me be clear. Acid test ratio is also called as quick ratio. Shows the ability of a company to pay its current liabilities without having to. So that means, see, quick ratio, what is the concept we learned in quick ratio? In quick ratio, we learned that definitely company has to settle its obligations. They have to pay their current liabilities. So with what they'll be paying their current liabilities with their current assets, quick assets, what they have, right? Quick ratio. The formula for quick ratio happens to be quick assets by current liabilities. So if they have to pay this, they should have enough resources of this kind to settle these obligations. Am I right? Now,
yes, sir.
but what they're asking here, and what is that in quick assets? What is the difference between current assets and quick assets? See, current ratio also we were checking the short-term liquidity position of the company, whether company is able to pay its current liabilities with the funds what they hold or what they have. So like if suppose 2 lakhs was my current assets and 1 lakh was my current liability. So definitely this 1 lakh I can easily pay with the available 2 lakhs what I have. Okay. So that was the indication that the company's liquidity position was strong. In the same way now we are checking the company's liquidity position with the help of quick ratio, but in a more shorter span of time, let's say in 6 months. So here, like I said, if you have 1 lakh worth of quick assets and 1 lakh is your liability, so you can easily pay off this because you have this resources. And I have given detailed explanation regarding what is the difference between current assets and quick assets. The only thing what the difference you find here is the difference of inventory, right? Because current assets have inventory as well in them. See, current asset is like inventory is included in current assets, but quick assets does not have inventory included in them. So excluding inventory, all the current assets are quick assets, right? Now, by after knowing or understanding all the knowledge regarding this, can you answer this question? What will be the answer option for this? Hello.
So, collected receivables.
No. Now coming to that, see, the acid test ratio or quick ratio shows the ability of a company to pay its current liabilities without having to liquidate its inventory. Why? Because inventory is never a part of quick ratio. Because inventory is not a part, inventory should not be taken in quick assets calculation, right? Hello.
Yes,
See, what is the difference between current assets and quick assets? I said current assets are all the current assets. Quick assets are all the current assets except.
lab, inventory and prepaid expenses.
Yeah, so inventory. So prepaid expense is not in the question right now. So except inventory, all the current assets are quick assets. That means without liquidating your inventory, you can try to settle your obligation or pay your current liabilities. That is what like that is what we can do. That is what we are checking the ability of the company in this case. We are checking with the help of quick ratio, with the help of quick ratio or acid test ratio, we are checking whether the company is able to pay their current liabilities without having to liquidate their inventory. Why? Because inventory is never a part of quick assets. So we need not liquidate or sell our inventory and get money and pay the current liabilities from that, right? Because inventory we
Yes,
won't consider, but we definitely take cash back. Cash is a part of quick assets, so we definitely will be using cash balance to pay the current liabilities. we will collect the money from receivables, and then what we can do, we can use that money to pay the current liabilities. We can borrow additional funds as well as to do that, because short-term loans are part of current liabilities, right? Only this is not a part of this ratio at all. We won't be selling our inventory and getting money and paying off the current liabilities in the case of quick assets, because we don't take inventory in quick assets, right? Next. Shall we move forward?
Yes.
Understood? Hello?
Yes, sir. Understood.
Yes, Samrin. If you're not getting, you can ask me. See, the question is in front of you. If you have any queries, you can just tell me right now.
No, it's clear, sir.
Okay. Then this question we will do fact pattern. RST Corporation comparative income statement. So this is an income statement. I have also explained my explained income statement in the video. So how many videos have you finished till now, Samrin?
Till now, I've covered 7 videos. Liquidity
7.
ratio.
Okay, I got the
Yes.
information from Siraj brother that you have seen 6 videos till yesterday. So today only 1, right? Hello.
Yes.
Yeah, okay, fine. No problem. You
Today I
can.
started market ratio, sir.
Sorry.
Today I started market ratio.
Okay, okay. You can take your time. No problem. Tomorrow also you have time, no? You can do after the class also. You can watch 1 or 2. Tomorrow also you can do that. Not a problem. Yeah. So this is a particular income statement in front of you, and I have also explained how to, make a income statement, right? And this is the balance sheet in front of you. What they are asking. So the entire income statement and balance sheet is given. I'll just show you the income statement and balance sheet. And meanwhile, what I'll do is I'll send you the PDF of these questions also. 2 minutes. So that with you, you can also like see the question clearly. Yeah, have you got the PDF? Please check it.
Yes, I see.
Yeah, you can open that. The question is like, liquidity. From that part you can start. And there is the question number 2. Okay. So this is the screen in front of you. They have given this income statement. What are they asking you to find? They're asking you to find quick ratio. So I don't think there is any need of income statement here. Unnecessarily they have given. Our data we will get from the balance sheet, right? So this is your balance sheet. So this balance sheet has all the like current assets till here.
Question number 2 in liquidity.
Yeah, liquidity. In liquidity, second question. Liquidity is the section in that second question. Did you get? Did you get
Yes.
that?
Yes.
Yeah. So as you know, they're asking quick ratio calculation. So income statement they have given unnecessarily. There's no need to consider that. Secondly, you have balance sheet. In that we only require current assets. We don't want anything else, right? Because to find out quick ratio, you want what?
Hello.
Hello. Yeah. Can you hear me? Hello. Hello.
Yeah.
Yeah. To find out the quick ratio, what do you want? You want what? Current assets, right? Current assets and current
Correct.
liabilities. Yeah. So these are given to you. So this non-current asset is also of no use. Current liabilities are given from here to here. So our data, what we want is only the current liabilities and the current assets. Fine. So can you just find out the quick ratio just by applying the formula? Can you just try and tell me the answer? I'm waiting. So if you can tell what we shall take, I'll be taking. Can we take cash?
Yes.
Okay, and what are they asking? They're asking to find out at the end of year 6. So year 5 is also irrelevant for us. So I'll be taking cash 5,000 plus
Short market.
short-term marketable instruments, investments, account receivable we can take. Inventory shall we take?
No.
Very good. And what about the current liabilities? We should not take inventory. Accounts payable and accrued payables, right? So 12,000 I'll be taking there. Now 16 plus 3, 19, 19 plus 5, 24, 24 by 12, in the sense 24,000 by 12,000. So 2:1 is the ratio, right?
Yes.
So we have the option number B for this. Hence we have done this question. Now I'm moving to third question, right? Okay. So the next question is, a financial analyst has obtained the following data from financial statements. This is the balance sheet given to you. In order to determine ability to pay current obligations, the financial analyst would calculate the cash ratio. So now I want you to find out the cash ratio from this question. I'm waiting.
Zero 0.50.
So what we need to take? Yeah, we can we take cash?
Yes, cash and marketable securities.
Marketable securities, right? We won't take this. Very good. And then what about the current liabilities?
6 lakhs.
6 lakhs. Okay. So it is 0.50 is to 1. Good. Next one. Next question. Shown below are beginning and ending balances for certain of Grimaldi Inc.'s accounts. So this is the opening and closing balances. So they have given the balance sheet. And net income also has been given. They are asking you to find out the current quick ratio. So can you do this?
Yes.
Yeah. So they're asking to find out quick ratio at the end of the year. That means you have to take this year, 2000, this December 31st, right? So you'll be taking cash, marketable securities, account receivable, inventory. You'll not be taking this. And then current liabilities will be taking accounts payable, accrued liabilities. You'll
Yes.
not be taking deferred taxes. You'll not be taking bonds payable, right?
No.
What's your answer?
Quick acid ratio inventory is not applicable.
Yeah. Quick acid test ratio or quick ratio mean one and the same. Inventory should not be taken. So yeah, okay. This is acid test. Yeah, okay, fine. Yeah, I'm canceling it. Okay. Yeah. You should only be taking these three and
Last
these
two.
two. Yeah. Got the answer. You need to increase the speed.
Doing 1.51.
1 point, yeah, so 1.52 almost, right?
Yes.
Okay. Next question. So what are they asking? So let me tell you about working capital. Working capital is nothing but current assets minus current liabilities. And I have discussed about working capital as well. This is the fund which is required to run the business operations like smoothly on daily basis. That means whatever the financial needs of the corporation, uh, like the corporation would be requiring. Let's say this is ABC Corporation, and this ABC Corporation would be having some financial needs on daily basis. That means they have some expenses to spend on daily basis. So for that, funds they want or they maintain, there is nothing. Or I have said one more thing: excess of current assets over current liabilities, working capital. Let's say my current liability is zero and my current assets is $100,000. So what is my working capital? $100,000. This is the amount which I can use to meet my daily expenses, right? Hello. Did you understand something?
Yes.
Hello. Did you understand this concept? What I said?
Yes, sir.
Are you sure? Shall I move? Shall I show the question?
Yes.
Hello. Hello. Yeah. Okay. 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 Please read this. Yeah. So working capital, once again, I'm giving a repetition. So let's say ABC Corporation's current liability is zero, nothing. They don't have any liabilities to pay, and their current assets is $1 lakh. That means that's the current assets what they have is only cash. Let's say. So what will be their working capital? The excess of current assets over current liabilities. How much here? 100,000. How? I subtracted current liability from current assets. So this is the money which I have, and this is what I can use to run my business or meet my financial needs of the business on daily basis very smoothly, right?
Mm.
Please read this question. Excuse me, I'm getting a call. 2 minutes. Hello. Yeah. Shall we discuss this question or you're trying this? Hello.
So I think B1 decreased by dividend declaration and changed by dividend payment.
Okay, we will discuss this. What this question says, we will understand. So excerpts from the statement of financial position of Landau Corporation as of September 30 of current year are presented as follows. So this is the balance sheet they have given. But what is their agenda? What they are asking? Let us first clear this. Okay. So what they are asking is the board of directors of Landau Corporation met on October 4 of current year and declared the regular quarterly cash dividend amounting to this much. That means on whatever the share capital they have, they are giving a dividend of this much amount. They have just declared, it seems, right? So, so what is the entry when you declare the dividend? Yeah. So when there is a declaration of dividend, it will debit the retained earnings account. Retained earnings account debit. Two, it will create a liability. Dividends payable. Right? Are you following somewhere in this one?
Yes.
So when there is a declaration of dividend, can I say there is a liability which has got created right now? When company declares the dividend, they have to pay it or not? Yes, they have to pay. So they will debit the retained earnings. Retained earnings are equity. Okay. Equity always shows credit account. But since the equity is going to decrease, we will show debit account. Okay. Let me be very clear. See, equity is nothing but capital, and capital here is not something which when we used to do sole trading concerns accounts, we used to take just capital, right? But in company form of organization, capital should be taken from should be considered in a broader sense. It is nothing but share capital, retained earnings, okay, and any like changes, like any kind of reserves, etc. All this would be a part of equity. And you know, when you pass journal entry for capital, it is always taken in the credit side. For example, Alex started business with capital of $100,000. What is the journal entry for that? The journal entry is cash account debit to Alex capital account, right? So capital is always credit. It is in the credit, or it shows credit balance. But when you declare dividends, what will happen? It will reduce equity. So when reducing, when the equity gets reduced, you have to give a reverse statement for that, right? When equity increases, it is credit. When equity decreases, it is debit. Am I right? Hello?
Yes. Right.
Right? And then when liability is created, increase in liability is always credit. So I'll give you some rules regarding journal entries. In Indian context, you have learned in a different way. I'll tell you some good basics here. You may be knowing, but I'm explaining this. So anytime, okay, increase in asset is always, so increase in asset is always debit. Decrease in asset is credit. We take up ACA classes, so we follow this kind of concept for journals. Increase in liability is credit. So as our liability is increasing, I have put that in the credit side. Decrease in liability is debit. Okay. Increase in expense is debit. Decrease in expense is credit. Increase in income is credit. Decrease in income is debit, reverse treatment, and capital is always credit account. Drawings is always debit account, And any kind of reverse treatment to this. That means if this is increasing, it's credit balance. If it's decreasing, it is debit balance. So increase in capital, decrease in capital, debit. Okay. So that's what I have done. But so with this, what is going to happen? See, retained earnings is not going to do anything to my working capital because it's not a part of working capital at all. It's not a current asset or something, but dividend payable is going to increase my current liability and that is going to decrease my working capital, right? Hello? Hello?
Hello.
Hello. Yeah. See, dividend payable is a current liability, right? So when current liability increases, your working capital happens. What happens to your working capital? It
Increases. Same.
decreases, of course, because let's say my current assets are 2 lakhs. My current liabilities are 1 lakh. So my working capital is 2 lakhs minus 1 lakh, 1 lakh, right? But let's say if dividend payable is a liability, I'm increasing my current liability with 30,000. So sorry, I've occupied a lot of space. So now my current assets are 2 lakhs. My current liability is 1,30,000 because new liability has got added. So 2 lakhs minus 1,30,000 is 70,000. My working capital has decreased or increased? Decreased, na?
Increase.
Hello? Decreased, right? So with dividend declaration, my working capital will decrease. But when I make the dividend payments, what is happening? So what happens? This is cash account. So my current assets are 2 lakhs. My current liability is, 1 lakh, let's say. Okay. And 1,30,000 we can keep it. So my working capital decreased, right? Previously, what was my working capital? Current assets was 2 lakhs. Current liability was 1 lakh. My working capital was 1 lakh. 2 lakhs minus 1 lakh, right? So what has happened? My original working capital was 1 lakh. My working capital after dividend declaration has become 70,000. It has decreased. Now I will make the dividend payments now physically. So what will happen when I make dividend payments? This 30,000 will be removed, right? Right? And my current liability will become 1 lakh. So I'll do that. Yeah. So current assets 2 lakhs. I am reducing 30,000 cash because I have to make the payment. And current liability I had 1,30,000. I'm removing 30K from this also. Right? So this is becoming 1,70,000. This is becoming 1 lakh. Right? So like dividend declaration liability got created, nothing in the asset, but now dividend payments will be happening. So my current liability will be 1 lakh. Yeah, okay. Working capital decrease that we have discussed. So what is happening? It is reducing by the same amount, right? So what is the answer here? 70,000, right? So any change in working capital, it's the same.
Same.
Same. Okay. So because equal amounts are reduced from both the after like when dividend payment should happen, 30,000 will go from current assets and 30 will go from current liabilities. So whatever the working capital we found out after dividend declarations is the same kind of working capital we are getting after dividend payment. There's no change at all, right? So the option what I have to consider here is option number 2, decreased by dividend declaration and unchanged by dividend payment, correct? Okay. So we have discussed everything. Just question number 6 you can solve something. I'm waiting. Clear now that question? Any doubts in that?
No, sir, clear. Sixth one.
Yeah. They're asking the inventory balance.
So quick ratio is 0.8.
Yeah. Quick
Assets.
assets. I'm saying quick assets by current liability is 0.8. It means that. See, company has current liabilities of this. So you can take that in the denominator. Working capital of 3 lakhs. Okay. And the company has a quick ratio of 0.8. Inventory, company has inventory of dash they're asking. So if I take working capital, so like we will do one thing. I'll take up a fresh page and solve this. So company has a current liability of 20 lakhs, 2 million, net working capital of 3 lakhs. Quick ratio is 0.8, inventory of how much they're asking, right? So we know that quick ratio has been given us 0.8, that is quick assets by current liabilities, 0.8. Okay. Now coming to current liabilities, it is 20 lakhs. If I take 20 lakhs here and just cross multiply there, quick assets would be how much? 16 lakhs, right?
Right.
Yeah, I got quick assets, right? 16 lakhs. So working capital is what? Working capital is current assets minus current liabilities. 3 lakh is the working capital. Current assets minus current liability. See, if I get current assets, I can easily find out my inventory balance. I will tell you how. So I know what is my current liability, right? It is 20 lakhs, correct? So current assets minus 20 lakhs is 3 lakhs. If I take 20 lakhs here, current assets is 23 lakhs, right? Hello?
Yes, right.
This is minus. If I take it there, it will be plus. So 20
Yes,
plus 3
20.
is 23. Yeah. So current assets minus quick assets is inventory, na?
Yeah.
So 23 minus 16 is how much? 7. This is the answer. Right? Make a note of this. We'll go for the next question.
Tons.
Next question. Yeah, so North Bank is analyzing Bele Corporation's financial statements. So banks, companies approach banks for loans. So these banks, they will assess the company's statements for a possible extension of credit. So Bele quick ratio is significantly better than industry average. So in whichever industry Bele Corporation is operating in that industry, considering the industry average, Bele Corporation's quick ratio is better. That means liquidity position of Bele Corporation is good. Which of the following factors should not consider as a limit using this ratio when evaluating Bele's creditworthiness? So they're asking possible limitation. Yeah. So if I have to explain, Bele may need to sell available for sale investments to meet its current obligations. See, available for sale is not for short span of time. These are long-term investments. What are they? Hello. Hello. Hello.
Yes, sir.
Can you follow me? Can you hear me?
Yeah, I'm listening.
See, there are three types of security investments. Like one is trading securities. One is held to match. One is like I'll tell available for sale securities. And one is held to maturity securities. What is the difference between all these securities is you should understand first. Trading securities are only meant to sell. That means there are certain, brokerage firms or there are certain traders who have some securities. Those securities they hold not to, those securities they are having with the motive to sell immediately in the market if they get a customer, right? That means these kind of securities are like inventory for them. These kind of securities are inventory for them. Yeah, excuse me, excuse me. So like trading securities are meant for trading purpose. That means if they get the customer, they'll sell it. Available for sale securities, they want to hold these securities for some period of time and then they want to sell it. So probably 5 to 10 years is what I can, 5 years, probably limited period is 5 years. They want to hold it and they want to sell it. So if it is 5 years, it is non-current, right? And held to maturities, they don't want to sell it. They want to hold them till the maturity date. Generally, this is applicable for bonds. Okay. Here, equity and bonds both can come. These are purely equity or bonds because, these securities are just for the purpose of selling. That means brokerage houses or traders, they sell these securities. These are like inventory for them. These are for investors. These are also for investors generally. Okay. Since if they sell, make the payment of current obligations, that is not a, something to be in consideration. Creditworthiness with respect to quick ratio. Why? Because under quick ratio, long-term investments we don't consider in the numerator, right? Shall I move forward? Is this point clear to you? Hello.
Can you explain again, sir?
I am saying when we calculate quick ratio, we take only short-term investments, not long-term investments. So if long-term investments are sold to meet current obligations, even the bank, North Bank, which is assessing the creditworthiness of Bele Corporation with respect to quick ratio, will not be able to decide, will not be able to evaluate the Bele's creditworthiness with respect to this condition. Why? Because long-term investments is not a part of quick ratio at all. Correct?
Yeah.
Hello. If short-term investments are sold and current obligations are met, then that's okay. According to North Bank, which is considering quick ratio as a parameter to check the creditworthiness of Bele Corporation, can be satisfied. Why? Because short-term investments have been used to make the payments for current obligations or current liabilities. But long-term investments is not a part at all. So that shouldn't be considered. So first option won't go. Second, fluctuating market prices of short-term investments may adversely affect the ratio. That is absolutely right. Why? Because if short-term investments I have taken for $10,000 and suddenly the prices have gone down and it has become just $2,000. So is it going to reduce my quick ratio or not? Please tell. Because short-term investments is a part of numerator, right? I'll take the short-term investments in the numerator of quick ratio. So my quick ratio will decrease or not? Yes. Bele need to liquidate inventory is not at all a part. Increasing market prices, inventory is not at all a part. So the option is second one, right? You can just once again assess. I'm going for the next question. See, practical anyone can do. Theory questions are the tricky ones here. So you should be focusing on them. That will make your concept more stronger. If done, we can move forward. I'm waiting. Just confirm.
Done.
Now, a firm has following current assets. What are they asking you? Current liabilities are also given. Now, this question you need to do summary. I'm just showing the screen. So I will read it. Firm has following current assets, current liabilities given. They're asking current ratio will decrease if a payment of this much cash is used to pay this much of accounts payable. Acid test ratio will not change if payment of this much is used to purchase inventory. Acid test or quick ratio will decrease if this much payment of cash is used to purchase inventory. Current ratio will not change if the payment of this is used to pay this much of accounts payable. So here these two are kind of like opposite questions. Current ratio will decrease, they are saying. Current ratio will not change, they are saying. Okay, rest of the question is same. I don't see any relevance of inventory in case of quick ratio. So these two I can ignore. So my option will be from A and D. Now you should tell me the answer for that. Okay, carefully we need to assess. So I am not giving any kind of hints here. You can consider all the four options. Okay. So first option, current ratio will decrease. So you have this first, you need to find out the current ratio and you have to find out the quick ratio. First, current assets upon current liabilities, quick assets upon current liabilities. So first I'll give the data to you to find out this two, then we will see what we can do. I'm waiting.
A, current ratio will decrease the payment cash
Okay,
is used.
first of all, what is the current? Yeah, first of all, what is the current ratio? Current ratio is 2.6 by 1.3. So it is 2:1, right? Yeah. So current ratio will decrease if payment of this much cash is used to pay this much of accounts payable. So first of all, if I reduce, let's say the current ratio, if I take 26 lakhs, or let's say 2,60,000 will take 2,60,000. 1,30,000. We'll just remove 10 for the sake of calculation. So I'm just removing 1 lakh. So I need to remove 1 lakh here also, no?
Yes.
So it is like 1,60,000 by 130 minus 10 is 30. So I have 1,60,000 divided by 30,000. What is the ratio? Yes. The ratio happens to be 5:5.3. It is increasing, not decreasing. Correct. This is not the answer. Just look at the second one then. Hello. Okay, I'll do the second one. What is the quick ratio? Acid test ratio. First, we will see what is acid test ratio. We need to take cash in hand, cash. We need to take 2.5 plus 1, 3.5. 3.5 plus 8 is 11.5. Okay. So I'll take 11,50,000 divided by 13 lakhs. 0.5 by 13 is my ratio. So it is 0.88, my ratio. Okay. Now what I'll do is acid test ratio will not change if payment of this much is used to payment of this much cash is used to purchase inventory. Yeah, see what is happening actually. I will see my quick ratio is like 0.88, correct? What I'll do right now will not change. So if I just pay some cash out of this, hello?
Yeah.
Hello. If I pay some cash out of this, that is 1 lakh, it is going to become 10,50,000 and my numerator is decreasing. So my ratio will further decrease. This is also wrong option. Third option. Acid test ratio will decrease if payment of 1 lakh is used to purchase inventory. 100% correct. 10,50,000 by 13 lakhs or 10.5 by 13 if you do, your ratio is decreasing. So I got my answer. It is 0.80. Previously it was 0.88 and current ratio will not change. If payment already we have seen the current ratio was this much and the current ratio is increasing 5.33 we got first time, right? So that is also a wrong answer. So answer option of C is right. This is wrong. Any doubts? Please ask me. I'm waiting. We'll go for the next one.
No.
Okay. Next question. Ninth one. All of the following are affected when merchandise is purchased. They are speaking about inventory on credit except see all of the following are affected. So let's say current ratio. We will assume something here, right? This is the balance sheet. This is current assets, current liabilities. I'll take this as 2 lakh. This as 1 lakh. So all of the following are affected when merchandise is purchased on credit except what? So the numerator and denominator, like what we'll do, we'll take current ratio as 2 lakhs upon 1 lakh. Okay. Let's say we are buying some inventory now of 30,000. Right. So now what is going to happen? We will just add 30,000 here. Okay. Why we are going to add 30,000? Because we are buying some additional inventory. And we are going to add 30,000 in the denominator. Why? Because it has created a liability, payables of 30,000. I'm right or wrong?
Yeah, right.
So all of the following are affected when merchandise inventory is purchased on credit except. So yes, now 2.3 by 1.3. Previously it was 2:1. Now what is my ratio? I will check. So 2.3 by 1.3. My ratio is 1.76. So it has decreased. Yes, it has affected. This is right answer. But according to me, they are asking except. So one of the options is not changing. This is changing. This cannot be my answer. Total current assets. Yes, if I take 2 lakhs plus 30,000 of inventory, it is becoming 2.3 lakhs. It is changing. What about working capital? I will see. So previously my working capital was 2 lakhs minus 1 lakh, which was 1 lakh. Now it is 2.3 lakhs minus 1 lakh, 1.3 lakhs, sorry. Still it is 1 lakh, na? Do you think any change? So this is not changing. Current liability will increase by 30,000. This is changing. So the answer is this one. Okay. Let's go for the next one. Yeah, please go for this question. Just a second. Okay, 10th question. I'm waiting. So for everything, what you need to do is you have to assume current assets minus current liabilities working capital. You can take this as 2 lakhs, this as 1 lakh. That's the working capital. And then you can try to take some imaginary figures and find out. Okay. I'm giving you 2 minutes of time, Samrin. We'll be back in a 2 minutes time.
हॉटस्पॉट ऑफ कर रहे क्या? हेलो. हेलो. हेलो.
Yeah, I'm coming. I just said 2 minutes. I'm just having some work. Yeah. Yes. What's your answer? Hello.
For B 1 and 3.
1 and 3. Yeah, very good. Correct. 1 and 3 is the right option. What did you do in this? If you
We
purchase
have both
delivery
the
van,
choices.
yeah, if you take delivery van on cash, above cost a change, yeah. So if I take delivery van, what's going to happen? I'm going to pay cash. So 2 lakhs minus 50K if I pay. I have 1.5 lakhs. 1.5 lakhs minus 1 lakh is 50K. Previously, my working capital was 1 lakh, right? So change is happening. And third one, purchase treasury stock. If I purchase treasury stock, my cash is going to decrease and my working capital is going to decrease, right? Borrowed money by issuance of short-term debt. See, if I borrow money by issuing short-term debt, my cash will, like, let's say 2 lakhs. I'll get 30,000 cash. I'll add it. Okay. And my debt will also increase by 30,000, right?
Right.
So 2.3 minus 1.3 is still 1. So no change. Finish. Do this question.
Which the answer?
I think this is similar kind of question. No need to do. Similar kind of, just they change the words. So this is something I can give you as homework. Next one. 12th one you can do. 12th and 13th.
Your screen is not moving, sir.
You're not able to see the screen.
No,
I'm sharing. Okay. Now can you see?
no, it's stuck.
Okay, I'm calling once
That
again. I'm calling once again. 2 minutes.